Oh man, thank God we are out of September. So what a month September was. And now we're going to take a look at what we can expect in October. But let's just have a quick recap of the pain we went through in September. So September brought a whole realm of issues. I made a few notes here on my post-it note just because there was that many. We had the Evergrande crisis, right? Who can forget? We had this Evergrande crisis shaking up markets. We had CPI figure and a worse jobs figure. We had Chairman Jerome Powell speaking about tapering and coming out with the hawkish sentiments. And we had the dot plot, if you remember. So the dot plot came out. We found out more Fed officials are looking at increasing interest rates at the back end of 2022, and that got markets nervy. We had the debt ceiling issue. We had the potential risk of a shutdown. We had Senate hearings with Gary Gensler and Jerome Powell, Janet Yellen. We had the ongoing supply chain issues, and here in the UK, we were queuing 2 hours because of a fuel crisis. So, with that said, it's no wonder that September did, as predicted. If you go back and check out my videos, I said September was going to be a volatile one, and it played out to be exactly that. We saw the S&P break a 7-month winning streak in September. So the S&P was down 4.8%. We had the Dow ending down 4.4% on the month, and the Nasdaq 5.4%. Got a good correction on the Nasdaq, and we discussed why, right? Throughout the month, we saw that the risk of inflation started to become more permanent. We saw even Jerome Powell, who this whole time was saying it's transitory, started changing his tonality and saying it's going to be a bit more persistent. And the market is obviously going to flock away from bonds, which drove the yields up. We saw the yields hit a June high. So yields ticked up, and we saw rotation away from tech stocks, which is why the Nasdaq was down 5.4% in September. So that is your recap on September. Now, does it get any better for October? Well, kind of and kind of not. So with October, the scene is as follows. So let me see if I can share this image with you. Look at this. So in October, you can see that October is the most volatile month using data from 1896, okay? So over 130 odd years of data suggests that October is almost double the volatility of the average of all months, okay? So you can easily see this is, over the 1.4 standard deviations mark, whereas the month we just got through, September, which felt volatile, was sitting at 1.1, just over 1.1. So, we are heading into a volatile market, and October has notoriously been a volatile market. Now, the question arises, what else have we got? Well, we know Jerome Powell is going to be coming closer to a decision on tapering. We know we get a CPI reading, I believe, on the 13th of October. We'll get another jobs figure. And then later on, we'll get Jerome Powell in the month speaking about whether we're going to see some tapering. Now, he said he wants to see continued improvement. He said we don't need an amazing jobs figure. We just need a good, solid jobs figure, and that could potentially start the tapering announcement. So I'm expecting an announcement of some sort of tapering starting in either November or December. I think the market is broadly expecting that as well. Now, so that takes up that issue. Now, the other thing that's going to be weighing on some investors' minds are earnings. However, I don't think earnings are going to cause as much of a problem as we may seem. I think we understand that, earnings are going to be taking a hit due to some of COVID, but we're going to get enough earnings growth by the end of it. And I think more of the concern is around supply chain shortages and inflation. So my prediction going into this month and with this earnings season is we're going to take a look at the earnings, and what's going to be more important is listening out on those earnings calls for any disruption to supply chains. Because, I made the video before where the CEO of VW, the CEO of Ford, GM are saying, these supply chain issues could back into 2023. Okay, so initially where people are saying, oh, this is just, transitory and everything's going to fix itself, it's going into 2022 and even longer, towards the back end of 2022 and early 2023. So we're going to be listening out in those earnings call for issues around supply chain. And the reason that's important is if we continue to have supply chain issues, then this is not a demand inflation. This is based on a lack of supply. Okay, so the demand is there, but businesses are unable to fulfill the supply. And when that becomes the case, you can have fears of stagflation, okay, where you have persistent inflation, but low economic growth and low employment, right? So high unemployment. And that's the concern. Whether that materializes or not, it's too early to tell. That's going to play out over the next few months, but the signs are there for markets to be concerned. And if markets can potentially be concerned as investors, that's what we need to worry about, right? We don't need to be worried about if it happens or not per se. We need to be worried about if the market thinks it's going to happen, because that's what gets priced into the market. So if the market believes tapering is going to happen, it will get priced in the market. If market thinks inflation is going to be persistent, it will get priced into the market. So we'll need to be looking out for these supply chain conversations to see if we hear things from CEOs and from companies around difficulties in the supply chain, and if that continues to persist and they're using language which suggests that it's going well into next year, then that could potentially put into investors' minds that inflation is here to stay. And you guys know what's going to happen when we hear things like inflation is here to stay. It's at that point that you want to look at the 10-year, which we have seen tick to 1.54. You want to start looking at that to see if we're going to get a higher figure. Okay, and we saw the 1.745 figures in March earlier this year, 1.7s, 1.7s, 1.6. Are we going to start heading back towards that? Because if there's fears of inflation, less people are going to buy bonds. That drives the yields up on bonds. If less people are buying it, the price goes down, yields go up. Okay, they're inversely correlated because the coupon, the future cash flow payments on bonds get eroded by inflation. Same for tech companies, right? So I would expect if the yield starts climbing, you will see a rotation out from equities because less companies are willing to put their money in high risk growth stocks, because again, inflation erodes the growth coming out of those companies. And as well as that, high growth stocks require a lot of cash. And if the interest rates go up to tackle inflation, which is the mechanism the Fed will use in the back end of 2022 once tapering is complete, then that makes it more difficult for tech companies to raise cash, to borrow money, to fuel their ongoing research, growth, and product lines, okay? So this is the macro kind of view we're looking at going into October. What are we going to see in terms of earnings? It's not around, your revenues and EBITDAs. Obviously, companies will fluctuate based on that, but the overall market trend and sentiment will be dictated by the perceived risk of inflation if we continue to see inflation risk to the upside on a persistent nature. If we do see so, we could see yields climbing back to March levels, and we could see more of a correction. We've had a 5% correction in September. It's not out of the realms of possibility to see another 5% correction or more in October. That being said, how do we need to react? What's my mindset going into October? How am I going to position my portfolio heading into this month? Well, I think whenever you're heading into a high volatility period, and by the way, when I showed you that chart of October being the highest volatile month, there may not be a fundamental reason for why that is high. But again, it's the perception. It's a self-fulfilling prophecy in that if investors always believe that October is going to be risky, it becomes risky, okay? So what I would be playing with this is I would be sitting back and I'd be making sure I'm focused on my high conviction plays. I'll be having some cash to the side, waiting for a correction. If we get another 5% correction, we've just had a 5% correction. If we have a knife, and I was nibbling in September, by the way, and I made that clear during my videos, I was buying some of my favorite stocks and lowering my cost basis and adding, in some instances, even buying higher than some of my cost basis because it's a good dip. A 5% correction when we've had 7 months of winning was a good opportunity to buy, and I bought on those red days. If we see the same in October, I'll be ready to buy in my favorite stocks at those lows. I won't be chasing it. If we bounce back and we recover the losses of September, I won't be chasing. I'm happy with my positions. But if it gets more bloody and we see more cheaper companies, I'll be diving in. And let's take a look at some of these just to get a view. So if we take a look. So let's take a look at these. You can see all the Bitcoin plays are up, of course, today. You can see Uber up, Zoom, Enphase at 154. I was nibbling at 149. If I see that again at 149 and lower, I'm buying some more. Love me some Enphase. Corsair, happy buying this in lower 20s. 26 is up 3% today. I wouldn't be chasing this just yet. If that got a correction in October, I'd want some more. Coinbase, yeah, Coinbase has been low for a while. I mean, it's obviously up today because of Bitcoin, but Coinbase would have to be in 220s for me to buy heavy. Happy with my position in Coinbase. Palantir went on a good run. Again, Palantir, I want to see, for me to go heavy, I want it back in 21s, 22s. It may not get there. It's fine. I'm happy with my position, right? But if we do see a bloody October, that's what I'm looking for. Square, I'm happy around 220. 220, I'm picking me up some Square if it ever gets there. Again, I've got a good position in Square, so I don't have to go chasing this. And that's the pattern you guys should see. I'm happy for these to run. Like Tesla's another example. I was buying this 590, 560 in March. You know, it's hard for me to buy now at 780, right? If it corrects back down, get low 700s, maybe I can nibble if I'm disciplined, but it's hard because of where the cost basis is right now. So nothing I'm chasing there. Roku, yep, I definitely lowered my cost basis on Roku. Roku's been taking a bit of a hitting recently, so I'm happy to buy Roku 300 mark. Roku is a good one for me, but I know a lot of people are rotating away from Roku for whatever purposes. Matterport starting to get juicy again. If this falls a bit more to 17, 16 mark, I'm building out my position in Matterport. I've got a decent position, but I want a much bigger position in Matterport. I do believe in their model going forward. Lucid, I've got plenty in. I won't be chasing it at this mark. I had plenty of time around 19, 20 mark to be buying that. I've got plenty in there. Etsy, 190s are interesting for Etsy. Lemonade, 64 is a good level, and I have been nibbling in September on Lemonade. If that falls below 60, I'll take me some more, because these are exactly the type of high growth stocks which are going to take a beating if we see persistent inflation. The Lemonades, your SoFis, your Affirms, these are the kind of companies, Rokus, which will take a hit. They will, and the SPACs, they'll take a hit if we see perceived inflation, because high growth companies will be, their future cash flows will be seen to be eroded by inflation, and the cost of borrowing for them will be higher, and that's what will rotate investors away from those into more safer, cash-heavy companies, which is how the institutions will work. Anyway, guys, hope you find that useful. We got through a bit of a bloody September. Hopefully you guys had the discipline to stay in your high conviction plays. You didn't panic sell. You found your opportunities. Like I mentioned in the video where I said how to trade uncertain market, you sat on some cash, you had your target prices, and like a disciplined investor, you bought in at the appropriate levels. Let's do the same in October. If we get another 5%, 10% correction, be prepared to buy in at lower cost bases. See it as an opportunity, because when the market rotates back up, we're going to be happy. If October doesn't happen to be a bad market and everything is looking fine and dandy, great. Happy with our positions. Let it run and let it head to the upside. All right, guys, hope you guys found this useful. If you like this type of perspective, then please don't forget to hit the like button and subscribe, and I'll see you in the next video.